This is the Skin in the Game VC podcast, hosted by Tom Wallace, entrepreneur turned venture capitalist and the managing partner at Florida Funders, along with Saxon Baum, general partner and head of investor relations at Florida Funders. You'll learn from the best about investing in early stage tech companies, so you too can gain the confidence and find the tools that help you succeed as an angel investor. Are you ready to get some skin in the game?
Hello, everybody. This is the part of the segment of our All In podcast where Sachse and I kind of like to banter back and forth, just talk about what's going on in the industry, what's going on in the world, and how it might have an effect on venture capital, technology, innovation, and the world in which we live in. We're getting down to the wire here, Sachse. What do we got? 2 weeks left before we're going to find out who the next president is.
Somebody told me yesterday, hey, you got 3 weeks for the new president. Two. And it was taken aback. I was like, crazy. It came right up on us.
Yeah. So who do you think is going to win this? And what do you think it means to our world?
You know, I see these betting markets, and we're huge fans of the All In pod. And they talked about this a few weeks ago. How accurate are these betting markets in the sense of predicting who's really going to win? Well, it's a prediction market, but the prediction markets are really skewing towards Trump right now. So I think Trump is probably going to win. The outlier here would be just like with the prior election or two prior elections with Trump and Hillary. Nobody would admit that they were going to vote for Trump, right? So everybody thought Hillary was going to crush him, and it ended up being the opposite. So I think the only thing, in my opinion, that could really skew this the other way is if people won't come out and say that they're voting for Harris.
I don't see that this election round.
I agree too.
As I follow it, I don't think people are feeling that way about Trump anymore. I don't know if he's changed or the people have changed, but I don't know who wins. My one concern, if Trump loses and it's really close, we got the whole, he's going to say, hey, I really won. And
then there's going to be a whole toss up in the air, asterisks.
So who knows what goes on there. But I guess the question I have and thinking is, if Trump wins or Kamala wins, how does it affect venture capital? And how does it affect early stage startups, technology, innovation? What's your thoughts on that?
You know, you and I talked about this a few weeks ago, and I haven't. My rhetoric hasn't changed, and I think
hers has.
Hers has for sure. I mean, It's every other day, but we're not going to get into that. I think that probably a red win helps business as a whole, and for us, we are typically not that affected in the venture capital world by the macro trends, but we have been because of illiquidity in the market, M&A being down, and IPOs being down. I think a red win opens up those floodgates. That's sort of what I think would probably happen from a direct venture capital standpoint. I don't know if either one of them winning makes that much of a difference, but from a macro business trend, I think the red probably does favor us a little bit.
Yeah, I'm not with you on this.
Really?
No. I think if Kamala wins and I can't stand either one of them, but I'll vote for Trump. Full disclosure, because I like his policies better. I think Lena Khan and the SEC is very anti-business.
Yeah, that's a good point.
I think the regulation of the left is on business is stifles technology and innovation. She's even talked about taxing capital gains, which would be horrible.
Yeah, unrealized.
Yeah, horrible
gains.
for unrealized for founders.
Yeah.
So I don't like Trump, but I'm going to be voting for him because I think. I believe in technology and innovation. I believe it which makes us competitive in the world. I believe it would make this country great, and I think she and her and her side would be stifling.
Well, I think for me, a big turning point of the way that I was thinking about things was actually the vice presidential debate, which I don't know if you watched, but
I did. I watched quite a bit of it.
It was. At least I was very impressed with J.D. Vance. And up until then, I really didn't know much about him. I knew he was a venture capitalist, which is exciting and cool to see somebody that is in our industry make it that high in office. But he really articulated, in my opinion, where this country can go from a business standpoint, how he's going to tangibly and tactically help people. So for me, that was a pretty big turning point looking at this call it last year in this election cycle.
Yeah, and I think it's kind of interesting, when Kamala came out with that, what was it, $50,000 tax credit for startups. I thought that was a joke.
But it's on income.
Yeah, I mean,
it's not on revenue.
Yeah, startups don't make income forever, so it doesn't. That was just, to me, typical of her soundbite and saying whatever she needs to get elected. I know both sides do that, but I feel strongly that Trump would be much better for technology, for innovation, even though he's the tariff side of it. But we have, in my opinion, been too easy on other countries to take our IP, and he's very, very, very stern on that. I think that's good.
Well, you've also seen a lot of the heavy hitters in Silicon Valley that were primarily blue for years. They are supporting Trump. I mean, Elon being the number one of it, and I know we want to talk about that a little bit today, but he's basically on the campaign trail in these swing states with Trump right now.
Yeah, and imagine, and Trump has talked about getting him to right-size government, and I don't know anybody that doesn't think government needs right-sized. I think Elon knows a little bit about right-sizing. I don't know if you know the numbers on this, but when he went to Twitter, when he bought Twitter, there were 8,000 employees. He cut 80% of the employees, and the product hasn't changed from a back end standpoint at all.
No.
And so he knows a lot about it. And when he started building rockets, he was building for like a 60th of what NASA was spending on
First principles.
Yeah.
It's how he operates.
Yes.
And we could use some first principles in the United States federal government.
Oh my God.
I mean, that's something we could really use.
Well, we're looking at a $30 trillion deficit, and so fixing that and getting that right, to me, is very important too.
Yeah,
So,
agreed.
All right. Well, enough on the election. Moving on from that, we were talking before. The Starship. Speaking of Elon, I mean,
it's just unbelievable.
Yeah, I'm sure most of you saw on YouTube or maybe saw live this Starship's launch with the super heavy booster landing back on those chopsticks and becoming completely reusable instead of that. The boosters in the past all went out in the ocean and polluted, and they weren't reusable. And I think it's all based on what Elon's trying to do, is just get the cost of this down so low so that we can go to Mars. But it
was one of the most amazing things I've ever seen. I mean, to have that come down, and I love the analogy of chopsticks, because that's what everybody's been saying, because it literally looks like chopsticks catching this rocket. I mean, it was...
Talk about a needle in a haystack.
Yeah, needle in a haystack.
Jesus,
exactly.
So impressive.
Yeah,
so impressive.
And I thought, his announcement was that last week around robo-taxis, the robo-bus, and the robot. Although I do think the design looks exactly like iRobot, so whoever directed that movie and put together those designs, you probably need some royalties on it.
I don't know that movie, but
I'll send you a meme on it. I mean, it's identical. They look exactly the same. But yeah, I'm excited to have a robot do my dishes, and I know you don't, do your dishes or your laundry, so you're probably pretty excited about that too, right?
Well, Elon's been saying for a long time, I think it goes back to 2016, that, he's going to have an autonomous vehicle out within 12 months, 18 months, whatever. So way behind on this. Maybe we're finally going to see it and get there. I asked the guest on our last guest, who wins this, robo-taxi, autonomous vehicle service game. Is it going to be Waymo? Is it going to be Tesla? Is it going to be Uber? I don't know, but it's hard to bet against Elon.
Who's the customer for the robo-taxi? Is it cities?
Well, I think it just replaces Uber. So
Uber buys a fleet of these from Tesla?
Well, I think just how we'll have Uber and Lyft. There may be Tesla's version of it, but just how you would get a taxi or an Uber today, the thing that shows up has nobody behind the wheel.
Yep, got it.
And
so do you think individual people could buy robo-taxis and then use it to generate revenue for themselves?
I mean, I guess in theory, will it work out that way? I don't know.
That's what I was thinking about. It's just interesting. It's like,
I don't know they'll work out that way. I mean, in theory, it could.
Yeah.
Who knows?
Yeah.
But you have companies with tons of capital like Tesla. Why do they need your robo-taxi when they can just buy their own fleet?
Yeah, exactly. And they're manufacturing the car. So maybe Tesla just becomes the robo-taxi company, and you don't buy them from Tesla, but that's just another business unit of theirs.
Yeah. Well, I think it's going to be fun to watch them, and we'll see. I think we're finally getting to the point where we're actually going to start to see this.
Yeah, it's going to be fascinating.
Yeah. So, and then the other thing Bitcoin's made another big comeback. It's almost at its all-time high. I mentioned this with our last guest that it did about 66,000. It made it to 72 back in March, which is the all-time high for Bitcoin. And I think it's just interesting to see that with all the ETFs and everything that's happening in that world. It just, I don't know.
Why is it running? I mean, you follow crypto much closer than me. What's the bull run?
It's funny. The interest rates coming down have been good for Bitcoin.
That makes sense.
There's this whole thing about is Bitcoin liquid gold? Is it a non-correlated asset? Is it a great place to hedge? And so far, that hasn't really proved it is a correlated asset to the public. It'll move right with tech stocks, and the stock market's been doing well.
Yeah.
So that's a big part of it. These ETFs, where a lot more people,
more institutional money flowing,
more individual investors.
Absolutely.
I mean, you don't have to have a Coinbase account.
Yeah, they're
anymore.
comfortable buying it with their broker.
Yeah, and it's a hedge. It's a diversification play. So. There's something else, and I'm trying to remember. There was another.
Does the election have anything to do with it?
Well, I mean,
I don't know.
I mean, both candidates have embraced it.
Yeah, they're both pro crypto, right?
I think Trump more than Kamala, but I don't think that has a lot to do.
Well, yeah,
with
Trump coin, of course.
He does, with his watches and his gold sneakers.
Yeah, exactly.
That he's talking. Right. Yeah, crazy. So, but I always ask this in the lightning round, where do you see Bitcoin in 3 years or whatever? I would be surprised if Bitcoin's not a couple $100,000 a Bitcoin in the next 3 to 5 years. Yeah. I would be very surprised.
So I need to buy some Bitcoin.
But I've been wrong before. So.
Well, you've also been a Bitcoin holder for a while. I mean, and I haven't. But I have a little bit, but not directly associated.
I just look at it. It's a very small piece of my asset allocation, but it's I tell this story. I was on a panel back like 10 years ago, and it was when Bitcoin was trading at nothing, like $1,000 or $2,000 a share, whatever. I don't even remember. And I was on this panel with a young man who really understood blockchain and Bitcoin, and he said to me, Tom, who knows where this is going, but if you're an investor, why wouldn't you take 1% or 2% of your asset allocation and put it into this something that if it goes to zero, it's not going to hurt you. But if it and I wish I would have taken his advice then. So, but anyway.
Well, we got a great guest today, so let's get into it and go from there.
All right. Sounds good. Hello, this is Tom Wallace, and welcome to another edition of our Skin in the Game podcast. We're excited you're with us today. I'm here with Sachse and Baum.
More like you're here with me because you're back in Tampa. We got you back.
Yeah, I was in Utah for the summer.
We got you back.
And it's great to be back. I got back in time just for 2 hurricanes. Well, I missed Helene, although my house didn't miss Helene, my property didn't miss Helene, and then I was here for Milton and evacuated because I'm in flood zone A. So, but we're all good in Tampa. We survived.
All good in Tampa. Thank you for everybody for reaching out. I know so many people reached out to us, to Florida funders overall. I mean, it was a crazy time, but we're all good.
And we're supporting the community. Just if anybody's interested, we sent an email out to our investors. We did some research at Florida Funders, the best way to help out, and we're doing something with the Tampa Bay Community Foundation where we're raising funds and our team members, and we're making contributions to the community foundation, who is then doling the funds out to the appropriate nonprofits who are directly helping victims of Helene and Milton. So if you want to participate in that, you can just reach out to us, either to Saxon or myself, or go to floridafunders.com. I don't know if we sent an email up. I don't know if we put anything up on the website.
We didn't, but we'll talk about that later because I want to get it out on social. I think let's get it out there. Let's get it out to as many people as possible.
Yeah, because I personally feel very blessed and very fortunate, even though I had quite a bit of damage to my property. There are so many people that really got hit hard and really have it difficult. So we want to try to help them out. So
yeah, your dock was in your pool. If you didn't get the video that I sent you, so
my dock's gone, my boat's gone. But hey, again, I'm not complaining. That's a first world problem. I mean, there are people that have it really rough. So okay, so a couple things. We're going to introduce our guest here in a second. For those of you who are new to the pod, we always try to really appeal to both investors and founders. And a lot of times we have on as our guests people who are either investors or founders, and oftentimes both. So very excited about our guest today.
Absolutely.
Why don't you introduce David Sachs, because you know David a lot better than I do.
Yeah, absolutely. Dave has been a great friend of mine here for give or take 3 or 4 years. And Dave has an amazing background he's going to get into, coming all the way from the great state of Wisconsin. He is a cheesehead. I know it's hard to believe, but he is David Sachse, the founder of Family VC. Dave, thank you for being here today.
Awesome. Saxon, Tom, great to see you both. Glad you guys are doing well. Glad you're both healthy and families doing well, especially after the hurricanes, but happy to be here.
Great. We're excited to have you. David, you have a very interesting background, and you do a lot of different things, and we're going to get into that. And one is running a trade association, probably the wrong word, for family offices. We'll talk about that. But I thought, just to kick us off, just give us a little bit about your background and how you got to where you're at.
Yeah, that sounds great. So my background real quick, I work at my family's single family office that's based in Wisconsin. I've been here now about 10 years. And prior to that, I worked in the corporate world. I was a product manager for software. And then I actually tried to do my own high growth startup. But once I joined the family, I had to try to carve out my own niche because I didn't want to work at the operating companies that we still own. And I had to kind of find my way. So venture was one way to do that.
Go ahead. I was just going to ask you to tell our listeners is what really defines a family office? What makes a family office? Office.
Yeah, I think there's all sorts of definitions, and it depends on who you ask. Because if you're asking family members or if you're asking hired guns, most hired guns will tell you that a family office needs $1 billion in AUM because that makes a lot of their model make sense. But what I've seen is most family offices usually around at least 50 million type, and they're allocating across asset classes for the benefit of stewarding the wealth for the next generation. And that's the setup I'm in. I work at my single family office. There's eight staff, 3 family members, 5 other full-time staff. And that's exactly what we're doing.
Dave, one thing that I always thought that was so interesting about what you do is how involved you are in venture capital. We're going to talk a lot about that today, primarily about that. But it's much different than the typical family office that Tom and I work with at Florida Funders. Usually those family offices are really involved in real estate. They're really involved in the public markets, public markets, and fixed income, those types of things. But you're really dedicated to venture capital. How did you get into that? Why did you get into that? I know you talked about it being your niche, but just give us a little bit of background there.
Yeah, so some of it actually started with our public securities investing. I was fortunate, lucky, blessed, however you want to look at it. I got some liquidity from my parents' substantial acquisition of the manufacturing company in 2012 that created the substantial wealth for them. But my wife and I, we allocated to public securities and largely concentrated positions in technology stocks. But if you look at the trends and what's happened with tech companies going public, like Apple and Amazon versus Stripe, it's night and day difference. So part of what intrigued me is I wanted to capture some of the value in the private markets because a lot of my career at the family office has been invested in public tech stocks, and I followed some of the trends. Additionally, curiosity led me to it. I think it's fascinating always meeting founders, investors who are very audacious, building things that solve real problems. And then like the other thing is, again, like what I was saying before, I'm trying to carve out my niche in the family office, in my family's family office. So really helping with diversification, and then also keeping a pulse on innovation for our operating companies and just improving our operations at the family office. So it was a combination a lot of those things, in addition to just learn by doing. And I slowly started to do it, and then I just iterated and liked what I was doing. So I just dove in more.
Yeah, one of the things we've seen, Dave, with family offices we work with, as Saxon was mentioning, is typically, especially in Florida, the patriarch or matriarch or both that founded the family office, that created the majority of the wealth, they didn't do it in technology. It was real estate, construction, insurance, healthcare, whatever, you name it. But it wasn't in Florida. It wasn't typically technology. But now that the next generation's coming along, they're kids and they're taking over the family office. Many of them get excited about technology and early stage venture investing. They're kind of bored by real estate and some of the other asset classes, as am I, by the way. But, so, you know, it's kind of fun to see, and it's really been helping our tech ecosystem here in Florida. So that's something we've seen quite a bit of. And you know, you're very involved in this association of family offices. Are you seeing a lot of that too?
Yeah, you know, there's some statistics out there actually that, you know, there's been an explosion of family offices. There was only 6,000 in like 2019. There's over 8,000 today. They're projecting that gets over 10,000 by 2030. And the compounding AUM is just ridiculous. It's hard to even put in, to say it, but it's in the trillions. And, you know, the thing that's interesting is there only 35% of next gen in North America actually has influence on investment decisions.
That's interesting. I would have thought it would have been much higher.
Yeah.
So 55% in Asia, though. Asia is a lot more advanced with bringing the next gen along. But I see that trend in that metric only ticking up here in the next 5 to 10 years, because a lot of the younger generation grew up with technology in their face. In addition, there's this significant wealth transfer underway from the baby boomers on down. And I think more and more of that is going to be allocated to technology, whether that's under the VC umbrella or not. They're just going to allocate and invest in technology.
Well, and if you look at our LP base from Fund 1 to Fund 3, I mean, Fund 1, we had 5 to 10% family offices. Now we have well over 50% of our LPs are family offices. But the one thing I wanted to ask you, Dave, is Tom asked, what is a family office, right? We're now hearing people 10, 15 million, 20 million. They're saying they have a family office. Is that legitimate, or is them just putting that out there saying that they're a family office? Is there some sort of family office police out there saying, hey, you know, you're not a real family office? How does that work?
Yeah, I mean, it's not easy, because a lot of people do identify as family offices because they like the position of family office or an advisor, where they get wined and dined and constantly pitched and all that fun stuff. But to me, I don't care about AUM. I care about investment activity. And then you usually can do the back of the napkin to figure out if they are serious or not. But yeah, I mean, I don't look at it if you have 10, 20, 30 million AUM and you're just an individual that's allocating to a few asset classes as a family office. People like that might be on their way to establishing a family office and doing that for the next gen. But when I define a family office, there's a dedicated team that's working full time to invest across asset classes, and they're not just doing it on the side for funsies.
Yep.
So you got into early stage tech investing and venture. You explained how you did that coming out of the public stuff, and you're so right. Stripe's a great example. Companies are waiting so long to go public now. The days of buying NVIDIA is probably the exception, but the days of buying a public stock like Amazon, I think Amazon originally was only worth a couple $100 million, and then getting a 50s 100x return on that over quite a few years kind of are gone, because these companies, by the time they go public, they're typically already valued well into the billions. And we've even seen that with venture capital firms like SoftBank that are investing right before they go public. But if you really want access to outsized return, you have to go early. So we've seen a lot of that. How did you get involved with this association? You started this thing, right?
Yeah, so it's called Family VC. It's a community of now over 200 family offices, with 80% of those outside the Midwest, because I filtered everyone based off if they're venture active or not. Essentially, I discovered this by learning, by doing, essentially, and investing. And as I looked at, because I invest in both funds and directs, funds support my direct investing. But as I looked at hundreds of different funds, I was like, man, a lot of these sound the same. And realistically, capital is a commodity. And that's when it hit me in the face. Capital is a commodity for me. Why would anybody want to work with a random family office based in Wisconsin? So I just leaned into the hand I was dealt with the family office cards and said, there's got to be other peers like me that are trying to do this in a lone wolf fashion, while championing it internally, but also making sure you don't get one overed in the industry or bait and switched. And yeah, the last 7 years, I just slowly been building a network through individual in connections. And now I have Family VC, which is a network of over 350 people, about 220 family offices that does in-person and virtual events, ultimately to do venture deals and help family offices, be just consistent with what they're doing and not abandon the asset class. Cause that is what I see too many get burned. And they're like, why are we doing this? Let's go back to real estate. Let's go back to manufacturing and other stuff.
Yeah, and that's something that we hear all the time from, I would say, unsophisticated families, which, Dave, putting yourself in your position and educating these families is something that we as GPs really appreciate, because it gets the message out there to these families. I want to talk a little bit about deal flow for family offices.
Mm-hmm.
For years, and I think that you and I, would agree on this, and we've talked about it before, deal flow for family offices was probably much weaker than it is for venture capital funds. Now, and I know you just wrote a blog about this, it was very good. A lot of families are actually thinking that they're going to take over what traditional institutional VCs are doing. Can you talk a little bit about maybe the trajectory of what a family office investing in VC could look like over the next 10 years? And do you really believe that family offices could really augment institutional venture capital?
I don't know if it's fully augment. I would say it's more of a complement. I do think that the extreme consolidation that's taken underway with venture, as well as angel groups being over indexed for the last few years, is going to make family office capital a lot more important for the venture ecosystem. Absolutely. But, adverse deal selection, all investors battle. Especially family offices, because if they don't have a network in venture, oftentimes they index on trust, and that trust is usually through contacts in other asset classes. But if you're relying on your real estate, private equity, wealth manager people for your sole deal flow in venture, it's a very challenging game, and you're going to get adverse deal selection with limited upside. So ultimately, I see a lot of these families are going to, the people that are dedicated to venture like me, they're creating their own infrastructure internally, surrounding themselves with partners in the VC industry that they can lean on, and then also working with peers that are on a similar journey, so they have aligned incentives and it can actually share deals. So like, hey, I'm sharing this deal. For example, I shared a deal with 20 family offices last week at my monthly roundtable, and I don't take any fees or anything like that. I just say, hey, I'm investing in this amount. This is why I believe in this founder. Let me know if anybody wants to talk about it directly with me, or I'm happy to connect you with the founder or the fund manager. And so really finding people that you can align with, incentives, and ultimately trust is the huge game that family offices play. And I think it's going to only improve as there's more transparency brought to both the venture industry as well as the family office industry, because that's another dirty secret that a lot of people don't know. And I didn't know the first several years being in a family office is there's an entire industry out there that tries to monetize every single transaction a family office does, let alone their mere presence over a meal. So like a lot of the younger gen are waking up to that and are like, yo, we don't want to be treated just like sheep. Like, where are peers that we can share notes with?
And when you look at your deal flow as a whole on a macro level, where do most of your deals come from? in venture?
It's a variety of things. So I mean, I do a combination of outbound and inbound. I have
You do
several different.
outbound?
I do outbound. Yeah, when I
Yeah.
hit the
What's that
ground.
look like? I'm curious.
Yeah, I mean, so I have certain categories that I'm really passionate about, and also that correlates to family offices. So, like capital management and allocation is one. And if things are relevant to certain categories, and I think this family office network can strategically add value in the form of customers, distribution partners beyond, just investing, I'll take a look at it. So, yeah, there's certain problems that I'm passionate about, but then, there's certain areas too that we don't have the expertise and can't do it ourselves, like healthcare. So, like, we invested in a HealthX Ventures, and I lean on them for co-investments in healthcare because I'm really passionate about healthcare, but I also don't want to navigate that industry without having dedicated partners that know how to do it. So it's a combination of things, but I have forums on websites. I'm pretty accessible, although I've been heads down and I haven't been posting on social much, just as we've been trying to improve the infrastructure because I'm at an inflection point with the community.
Dave, a lot of the trends in family offices that Tom and I hear about are direct versus funds. A lot of family offices want to go direct rather than investing in funds. We hear this, but when it actually comes to practice, we don't see it really come to fruition. Can you talk a little bit about funds versus direct, how you think about it as a family office? Because I know the data shows one thing, but we still really have yet to see families going all in on the direct side.
Yeah, I mean, I can tell you why my hypothesis on that is because a lot of family offices say they want to do direct and say they want to do early stage, because you guys know, like, Series A and beyond can be very, very competitive for lead rounds and stuff. But when you share deals with them, there's not a lot of data there. And it's not like a PE deal or real estate deal where they can wrap their arms around it. They're like, hey, how is this worth 15 million? This company's only been around eight months. So, like, it's a hard, like, learning curve for a lot of them to adjust to. I'm sorry, what was the question? The second part of that question?
Just
To make sure I answer it.
Yeah, in terms of direct versus funds, we hear about it, but we don't see them really investing direct. They say they want to, but they really don't.
That's because they don't have the comfortability with the lack of information, and typically anything pre-Series A doesn't have product market fit, so they have a hard time wrapping their arms around it. That being said, if they're not working with venture fund managers like yourselves or others, they're getting into some very adverse deals that oftentimes VCs won't want to touch later on. So they're almost quasi PE VC. So it can be a dangerous game if you try to do venture yourself as a family office, if you don't have the technology network background and just understanding how to do venture. So I have seen that. But the best families and the most sophisticated take the two-prong approach. They invest in funds and direct. So, like, our model is every dollar we put into venture funds, we try to put 4 to 5 into directs because we believe that is the return profile that we're going for the risk profile of this asset class. We invest in other asset classes, so that's just our model for this one. But that's what I see with some of the best families offices doing it. Even so, some are doing internal fund of funds themselves just for the data and deal flow.
Well, the thing that I think sophisticated angels and family offices, and I consider myself one of them as an angel investor, is the key element of that is there's a couple of keys to it, in my opinion. One is due diligence, and who's doing the due diligence. If you're not doing this every day, there's a lot of due diligence that goes into, as you know, really making an investment if you're doing it right. And then put together the docs and the valuation and all that stuff. There's a lot of heavy lifting that goes into doing this right. And then diversification is the other big one. I mean, if somebody's doing direct, I don't care if you're a family office or you're an angel. If you don't have at least 10, 12 investments out there, you're really playing with fire. I'd use the analogy, you could go to the Hard Rock, the casino up here locally. If you're doing 2 or 3 or 4, that's what you're doing. And, it's probably not going to work out well. You might get lucky. You never know. But, we've seen that a lot with on the direct side that, people that they got, I'm going to, whether it be a family office or a sophisticated angel, I'm going to do some direct, and then they kind of lose interest in it, and they got 4 or 5 deals out there. And it usually doesn't end up well if you don't get, at least 10, 12 investments in the space.
That's definitely the biggest mistake that I've seen family offices make when getting into it is, other than relying on their existing network, it's doing a couple big checks like private equity and not taking a portfolio approach, especially when they're going Series B or sooner. And yeah, all of a sudden, 1 or 2 of those of the 3 or 4 go belly up quick, and they're like, why are we in this? And it's not easy to champion if you have something like that happen.
Yeah. Have a little fun. I always like to ask this of investors. So, what's your biggest win? And if you don't want to tell us the name of the company, you don't have to, but we'd prefer to hear it. And how big was the return? And what's your biggest miss that you passed on it, but it was the next Uber or whatever?
Yeah. So I think I didn't pass on it, but I didn't get an opportunity to invest. Fetch Rewards out of Wisconsin is a great company that's doing well. I wasn't as active back then, but there was a deal where it was under 50, but they're over, I think, $1 billion in valuation now. So that was something that I missed, but I also wasn't as active then and didn't have the networks and stuff. One that's done well, it's over 20x in valuation since we invested in 2018, but it's called Enzo Data. And that's a technology and AI software that essentially helps data scientists come to a conclusion in minutes instead of hours. And they're starting with sleep data around sleep apnea. And that company we have seen growing substantially. And again, without healthcare partners that actually know how to lead rounds, vet deals in that space, my family office isn't touching healthcare deals.
Dave, I want to go back to a word you used in the prior sentence. It's allocation. Tom and I always talk about allocation and how family offices should have X amount in this and X amount in that. What are sort of the standard allocations that you see within family offices when looking at venture capital? And I know when you have a multi-billion-dollar family office like Iconic compared to a $100 million family office, it's a lot different. But is there any standards that you sort of see around allocation?
Yeah, I mean, most wealth managers are good fiduciaries. Say, 5 to 10% should be no more than that type thing. But it really depends too on the family office and who is leading the initiative. So, like, another dirty secret about the family office world is if they're on Gen 3 or Gen 4, they might be in wealth preservation mode. And venture, unless there's someone internally championing it for some reason of diversification or innovation, it is not something that they want to take the risk on.
Preservation and venture capital are not synonymous terms typically.
I could argue that if you do venture right and you diversify and through funds, I wrote a blog about this. It's really not a riskier asset class. If you do it right, it's just, it's a long-term play. If you don't need liquidity, and you're in it for the 10 years, basically what each fund is and what a typical investment is, and you diversify, and you do all the right things, it outperforms every other asset class, and it's not risky. It's risky when you bet on 2 or 3 companies.
Yeah, back to your point, you do 2 or 3 deals, just go to the Hard Rock.
Yeah.
Hey, I have a tornado testing thing here.
Yeah,
so
I wondered.
You guys hear that? I'm sorry. It's right outside my office.
You're good. Let's just wait.
What is it? We can't get away.
It's
from
not a real
what?
hurricane. We don't have that.
Tornadoes?
We don't have those here in Wisconsin. So everything is good. But I was trying to stay on mute, so I'm sorry for that.
No worries. I was kind of curious, and when you look at venture, there's the early stuff, the pre-seed up to ABC. What stages do you play in, and where are you really? How do you look at that asset allocation within that, or do you just primarily focus on early stage stuff? I think you're focused on mostly early stage. I don't know that, but when you look at the stages of venture capital, where do you focus and why?
Yeah, so I focus typically pre-seed to Series A with, I would say 80 to 90% is in pre-seed or seed. The reason I go there is because of the return profile, also understanding the risk profile, but I know it's more collaborative, competitive in those stages than it is like very sharp elbow competitive in Series A, B, C, and beyond. And candidly, I also look at like the later stage stuff almost as a different asset class, because of what you're analyzing and how you're due diligence in it. So with what a lot of family offices struggle with is, hey, there's not a lot of information in pre-seed or seed companies. How are you diligencing this? Well, that's where I'd come back and tell them this is why I'm an LP in 20 plus funds, because I have funds strategically all spread out throughout the country, from San Francisco to Miami to Seattle to LA to Colorado, Minnesota, Chicago, all over, so I can have boots on the ground that I can back channel qualitatively, in addition to the quantitative stuff that I'm analyzing on some of this pre-seed and seed companies, because you guys know there's only so much quantitative stuff you can go off of, and having due diligence, and this is due diligence mindset of someone coming that doesn't lead rounds. So I initially, when I started out, I was like, yeah, I'm going to lead rounds. I'm going to do this. It's going to be great. And then I got in, I was like, oh, this is competitive. Like, I want to be a compliment, and I don't want to be just squeezed out in all the crappy deals that just want me to be a lead investor. So that's why I invested in venture funds, sought partners out like Saxon, who had similar thesis and strategy and style of, supporting companies post-investment as well. Because that's the other thing that
I think what
I
was going to ask you about. I mean, one of the reasons we invest early is because we look to invest in companies that and founders that we think we can add value to, that we can either, we have domain expertise. I hate to use that word, but knowledge, experience, whatever. Or we think, all of us are ex-operators, so we can coach a mentor, the CEO, we can be a good board member, all the ways we can add value. You don't really look to do that for the most part, do you?
Oh, no, I absolutely do. So what I was going to say, it was pretty underwhelming getting into the venture space and seeing how taboo or how jokey it was to say, yeah, I want to add value beyond the check. When, I mean, most of family offices, they think in terms of customers, revenue, and retention. They don't care about the next round's valuation if the customer revenue and retention isn't there. So, and a lot of them themselves are entrepreneurs. A lot of them still have operating companies that they wholly own. I mean, we have 3, granted they're small cap and not what Gen 1 or my parents made their substantial wealth on, but still we think in terms of customers, revenue, and retention. So in my memos, I have a section of how can we support this beyond the check. And you guys know the best investors have co-investors, so that's table stakes. So like, what else are you doing? And that's part of the reason why I built Family VC. So if you come to me and you say, hey, we have this software that does stuff for food manufacturers, I can come back to you and say, hey, I have 5 families that currently own these companies. I can double opt-in intro to some of their team if you want to do diligence and see existing stuff that they're using, or just to better understand. That's how I've actually built my venture career, is leaning into asymmetric information in the earlier stages by talking to customers who are using alternative solutions, and then just leaning in when I think I have asymmetric info. So I genuinely try to add value beyond the check, but like, I know how that's super taboo and often a big joke in the venture industry.
Appreciate it, Dave. Tom, you want to get into the lightning round?
Sure. So basically what we do here, Dave, is I'm just going to ask you to just have a few questions and give us a quick answer. And this is just a fun thing we like to do to wrap things up with our guests.
Awesome. Let's do it.
Okay. You ready? Who's going to win the election?
Oh, I would say the candidate that's being most transparent, which would be Trump right now.
And my understanding, Wisconsin's a big swing state, right? You guys.
Yeah, we're always treated as a swing state. It's always interesting during election season. I mean, the amount of the spam texts and it's overkill. So yeah.
Well, I think JD and Tim Walz were both in Wisconsin yesterday, right? And was Trump there yesterday too?
I don't think Trump was. Obama was.
He was at the Monday night game, the Steeler game.
In Pittsburgh,
because
Hey,
we're both from Pittsburgh originally. So
your Steelers played tough against Green Bay East, which I call the Jets now, because they have all my former Packers on it.
Okay. Look out 3 years. What's the price of Bitcoin?
84,000.
By the way, it just hit, what did it hit? 66,000. So what's the all-time high of Bitcoin? Anybody know?
67.
69?
73. Close. When did it hit it? March of 24.
Oh, wow.
Little trivia for there. You're there.
There you go.
Okay. Artificial intelligence. Overall, is it a job creator, a job destroyer, or neutral?
I think it's industry dependent, but I think definitely it's going to consolidate jobs. I think over the next decade or so. Long term, just like the internet, I think it's going to create a lot more industries and a lot more jobs as well. But the fear of hey, are you going to hop on with the lawyer all the time when a lot of this is boilerplate stuff? No, a lot of that stuff is going to be consolidated. But long term, I think it's going to create more.
Okay. And Elon just made his robo-taxi announcement last month, as you probably saw for the umpteenth time. And if you look at autonomous vehicles, robo-taxis, who's the winner in that game? Is it Tesla? Is it Waymo, Uber, Lyft, or some startup?
I mean, just from a business standpoint, I know he's a polarizing figure, but anytime somebody bets against the greatest entrepreneur out there who keeps proving it, Elon, I just think it's a bad move. So I would not bet against Elon.
There you go.
It's hard. It is hard to bet against Elon. All right. Well, that's it. Dave, this has been great. I think our audience will really enjoy the perspective you brought, which was really unique to any other guest we've had on from really running a family office and a family office association. Good luck and continued success at what you're doing. We look forward to doing more deals together. And Sachs, anything
Dave,
else?
thank you so much. We appreciate everything you've done for us today and for Florida Funders. For our guests, if you enjoyed the pod today, please throw us a follow, throw us a like. Tom and I love doing this, and we're going to continue to do it here on the pod. So thanks a bunch, everybody, for being here.
All right.
Awesome. Thanks, guys.
All right, Dave.
Thanks, Dave.
Thanks, buddy.
Really appreciate it.
Thanks for spending your time with Skin in the Game VC today. If you want to learn more about investing in early-stage tech like a venture capitalist, be sure to visit the Florida Funders website at floridafunders.com. Join our angel network at no cost and get access to Florida Funders VC-vetted investment opportunities in the next great breakout tech companies.